All right, Forex Militia. This is the end of the ebook, High Probability Trading Setups for the Currency Market. And these are rules from 7 to 10. Okay? Now, I do want to ask you, if you like what you saw right here in these rules, please give me a like and tell me which one of these rules that you like the most. And if you have a rule of your own that you would like to share, please put that in the comments. All right? Let's get to the end of this ebook, and that will be read by my personal assistant, Mia. All right.
7. Know the difference between scaling in and adding to a loser, and never make that miss. Take. One of the biggest mistakes that we have seen traders make is to keep adding to a losing position, desperately hoping for a reversal. As traders increase their exposure while price travels in the wrong direction, their losses mount to a point where they are forced to close out their position at a major loss or wait numbly for the inevitable margin call to automatically do it for them. Typically in these scenarios, the initial reasoning for the trade has disappeared, and a smart trader would have closed out the position and moved on. However, some traders find themselves adding into the position long after the reason for the trade has changed, hoping that by magic or chance things will eventually turn their way. We liken this to the scenario where you are driving in a car late at night and are not sure whether you are on the right road or not. When this happens, you are faced with two choices. One is to keep on going down the road blindly and hope that you will find your destination before ending up in another state. The other is to turn the car around and go back the way you came, until you reach a point from where you can actually find the way home. This is the difference between stubbornly proceeding in the wrong direction and cutting your losses short before it becomes too late. Admittedly, you might eventually find your way home by stumbling along back roads, much like a trader could salvage a bad position by catching an unexpected turnaround. However, before that time comes, the driver could very well have run out of gas, much like the trader can run out of capital, adding to a losing position that has gone beyond the point of your original risk is the wrong way to trade. There are, however, times when adding to a losing position is the right way to trade. This type of strategy is known as scaling in. The difference between adding to a loser and scaling in is your initial intent before you place the trade. If your intention is to ultimately buy a total of one regular 100,000 lot, and you choose to establish a position in clips of 10,000 lots to get a better average price instead of the full amount at the same time, this is called scaling in. This is a popular strategy for traders who are buying into a retracement of a broader trend and are not sure how deep the retracement will be. Therefore, the trader will choose to scale down into the position in order to get a better average price. The key is that the reasoning for this approach is established before the trade is placed, and so is the ultimate stop on the entire position. In this case, intent is the main difference between adding to a loser and scaling in.
Okay, with number 7, know the difference between scaling in and adding to a loser, and never make that mistake. The mistake that they're basically talking about is when your position basically is going into a losing position, is a losing amount, when it's at a loss. There you go. Do not add to it, because you've already put in place a stop loss, not a mental stop loss. You have a hard stop loss that you put in place, and that already accounts for the percentage of your account that you're already willing to risk. When you add to a position that you've already had put in place as a full position, right, you're adding to your risk. So if you're risking 1% altogether on that currency, on that stock, whatever it is that you're trading, adding to the position will cause you to risk 2%, 3%, 4%. And that is not what we're willing to do. We are willing to basically, once again, play out our edge, our strategy within the market, and stay solvent enough to basically play the game again. Okay, so with what they were also, with what this rule is saying, if you predetermine a predetermined course of action that you are going to scale into a position, is the only time that you should actually take other positions. And of course, when you break it up into the full risk that you are going to risk, like just like it said, if you're basically going to risk 1% and you break that 1% up into tenths, then you're taking a 1/100th, or a tenth of a tenth, right? A 100th of a position, and you're buying into a retracement. Now I'm going to show you exactly what I'm talking about. Like right now here on the euro, you have this here, and it retraced, and this one retraced to the 78.6. Now what I have here is a weekly support line that it basically came down and came past and went to the 78. This here is a 61. That would have been perfect if it would have stopped right there. Now you can basically take a position here at the 38, one at the 50, one at the 61, and then you can place your stop loss somewhere down here below the 100. Most likely I would say, if I was going to basically scale into this position, I would most likely start at the 38, then the 50, then the 61, and I would put my stop loss somewhere below the 78. So most likely on this one, I might have gotten stopped out, and then I would just have to wait for the position to move off into in the direction that I basically believed that it was basically going to go. But the interesting thing is, just if you understand what I would be doing, though, I would most likely cut a 1% position up into 3. So a third here, a third here, a third here, and then that's the whole position right there. And then I would get stopped out right around here, which of course would not add up to a whole 1%. I could actually put a stop loss somewhere around here, and still most likely I would not be risking the full 1%, because you can also see below here is this yellow line is the 200 moving average. So as long as it stays above there, so it's up to you. The interesting thing is, I don't have a site that I could give you that would allow you to enter a scaled in type of position so that you can get a stop loss. Okay, but I will, sometime in the future, I'll be looking for that. The only way that I would suggest that you could do that is on each third, get an amount risk that you're basically going to amount of pips that you're going to risk going down into your stop loss, and you will have to most likely do that manually to figure out if you're at the point of 1% or 2% risk. So that would be the only way that I would suggest that you can do that. Okay, so that's it for this rule. Let's get on to rule number 8, which is, what is mathematically optimal is psychologically impossible. Take it away, Mia.
8. What is mathematically optimal is logically impossible. Novice traders who first approach the markets will often design very elegant, very profitable strategies that appear to generate millions of dollars on a computer backtest. The majority of such strategies have extremely impressive win-loss and profit ratios, often demonstrating $3 of wins for just $1 of losses. Armed with such stellar research, these newbies fund their FX trading accounts and promptly proceed to lose all of their money. Why? Because trading is not logical, but instead psychological in nature, and emotion will always overwhelm the intellect in the end, typically forcing the worst possible move out of the trader at the wrong time. As E. Derman, head of quantitative strategies at Goldman Sachs, once noted, in physics you are playing against God, who does not change his mind very often. In finance, you are playing against God's creatures, whose feelings are ephemeral, at best unstable, and the news on which they are based keeps streaming in. This is the fundamental flaw of most beginning traders. They believe that they can engineer a solution to trading and set in motion a machine that will harvest profits out of the market. But trading is less of a science than it is an art, and the sooner traders realize that they must compensate for their own humanity, the sooner they will begin to master the intricacies of trading. Here is one example of why in trading what is mathematically optimal is often psychologically impossible. The conventional wisdom in the markets is that traders should always trade with a hours-minutes to 1 reward-to-risk ratio. On the surface this appears to be a good idea. After all, if the trader is accurate only 50% of the time, over the long run she or he will be enormously successful with such odds. In fact, with a hours-minutes to 1 reward-to-risk ratio, the trader can be wrong 6.5 times out of 10 and still make money. In practice, however, this is quite difficult to achieve. Imagine the following scenario. You place a trade in pound sterling to US dollar. Let's say you decide to short the pair at 1.7500 with a 1.7600 stop and a target of 1.7300. At first, the trade is doing well. The price moves in your direction, as pound sterling to US dollar first drops to 1.7400, then to 1.7460, and begins to approach 1.7300. At 1.7320, the pound sterling to US dollar decline slows and starts to turn back up. Price is now 1.7340, then 1.7360, then 1.7370. But you remain calm. You are seeking a hours-minutes to 1 reward to risk. Unfortunately, the turn in the pound sterling to US dollar has picked up steam. Before you know it, the pair not only climbs back to your entry level, but then swiftly rises higher and stops you at 1.7600. You are left with the realization that you let a 180-point profit turn into a 100-point loss. In effect, you just created a 280-point swing in your account. This is trading in the real world, not the idealized version presented in textbooks. This is why many professional traders will often scale out of their positions, taking partial profits far sooner than 2 times risk, a practice that often reduces their reward-to-risk ratio to 1.5 or even lower. Clearly that's a mathematically inferior strategy, but in trading, what's mathematically optimal is not necessarily psychologically possible.
Okay, so for rule number 8, this is what is mathematically optimal is psychologically impossible. The basic idea of this rule is tied into rule number 1, which is protect your profits. It's tied into that in this form. If you've done any trading in any of the markets, they basically will rest upon risk-reward ratios, and usually the standard risk-reward ratio is usually a risk of 1 to a reward of 2. All right. So as they've put in here, that is the standard risk reward. But the way how the markets move, it's not. It doesn't optimally move. It doesn't normally move to that 2-to-1 risk reward all the time. There are some very specialized trading strategies that will give you 2 reward to 1 risk. But most strategies do not have that type of risk reward. Okay, one other thing about this is the market is, especially the currency market, will normally trend about 30 to 35% of the time. That means the other 65 to 70% of the time it will be ranging. Now, range can also mean that the market is actually ranging on an angle, but usually that's trend-wise. What I mean by ranging, though, is flat. It's just going up and down inside of a contained range. So most trend trading strategies will only catch pips about 35% of the time. That means that the other 65% of the time you're most likely losing. This is another caveat, another part to this rule is that are you okay with losing 65% of the time or just winning 35% of the time? Can you psychologically handle losing that much just so you can get to the winners, the winners in your strategy? So that's one of those things. As in this rule, it says that the market is an art, not a science. Basically, that's basically giving you the understanding that the strategies that you basically come up with, they may look very good on paper, but the market is ruled by 2 things. Well, I'll say 2 things in truth: greed and fear. Okay, so greed meaning that the market will run in certain ways into basically a euphoria, and then fear, everybody's basically getting out of the market because they don't want to lose money, fear of losing money. These are 2 sides of a trader. Check this out. When you're winning a lot and you're getting tons and tons of pips in the foreign exchange market, you can turn to be overconfident. If you're losing 65% of the time, you can actually become hesitant to take a position because you're so bummed out that you lost so many pips. So since the market has that psychological aspect to it, you really have to learn how to deal with your emotions when you're in the market. So that's a little bit off topic of what Rule 8 is, but that's just a little window into what it is to actually trade in the markets. Alright, so let's go ahead and move on to rule number 9. Risk can be determined, but reward is unpredictable.
9. Risk can be predetermined, but reward is unpredictable. If there is one inviolable rule in trading, it must be stick to your stops. Before entering every trade, you must know your pain threshold. This is the best way to make sure that your losses are controlled, and that you do not become too emotional with your trading. Trading is hard. There are more unsuccessful traders than there are successful ones. But more often than not, traders fail not because their idea is wrong, but because they became too emotional in the process. This failure stems from the fact that they closed out their trade too early, or they let their losses run too extensively. Risk must be predetermined. The most rational time to consider risk is before you place the trade or when your mind is unclouded and your decisions are unbiased by price action. On the other hand, if you have a trade on, of course you want to stick it out until it becomes a winner, but unfortunately that does not always happen. You need to figure out what the worst-case scenario is for the trade, and place your stop based on a monetary or technical level. Once again, we stress that risk must be predetermined before you enter into the trade, and you must stick to its parameters. Do not let your emotions force you to change your stop prematurely. Every trade, no matter how certain you are of its outcome, is simply an educated guess. Nothing is certain in trading. There are too many external factors that can shift the movement in a currency. Sometimes fundamentals can shift the trading environment, and other times you simply have unaccountable factors, such as option barriers, the daily exchange rate fixing, central bank buying, etc. Make sure you are prepared for these uncertainties by setting your stop early on. Reward, on the other hand, is unknown. When a currency moves, the move can be huge or small. Money management becomes extremely important in this case. Referencing our rule of never let a winner turn into a loser, we advocate trading multiple lots. This can be done on a more manageable basis using mini accounts. This way, you can lock in gains on the first lot and move your stop to break even on the second lot, making sure that you are only playing with the house's money and ride the rest of the move using the second lot. The FX market is a trending market, and trends can last for days, weeks, or even months. This is a primary reason why most black boxes in the FX market focus exclusively on trends. They believe that any trend moves they catch can offset any whipsaw losses made in range trading markets. Although we believe that range trading can also yield good profits, we recognize the reason why most large money is focused on looking for trends. Therefore, if we are in a range-bound market, we bank our gain using the first lot and get stopped out at break-even on the second, still yielding profits. However, if a trend does emerge, we keep holding the second lot into what could potentially become a big winner. Half of trading is about strategy, the other half is undoubtedly about money management. Even if you have losing trades, you need to understand them and learn from your mistakes. No strategy is foolproof and works 100% of the time. However, if the failure is in line with a strategy that has worked more often than it has failed for you in the past, then accept that loss and move on. The key is to make your overall trading approach meaningful, but to make any individual trade meaningless. Once you have mastered this skill, your emotions should not get the best of you, regardless of whether you are trading $1,000 or $100,000. Remember, in trading, winning is frequently a question of luck, but losing is always a matter of skill.
Okay, for number 9, risk can be predetermined, but reward is unpredictable. Basically, you get the drift of this. They went over this a little bit earlier, kind of, in a sense. Only risk 1%. So basically, what you should always look to do is look to set a stop loss. To only lose 1% or 1 to 2% of your account. I would say 1%. Where we are not looking for the home runs, we are looking to basically risk small amounts to make basically home runs. Every once in a while, if you're trading a very strong trend, you'll get a large one, a home run every once in a while. But on the norm, since the market basically trends only about 35% of the time, we are only looking to basically hit home runs. The other 65 to 70%, it will be ranging. Okay, so always set a stop loss. All right. If we go back to this chart here, the reason why is because we want to preserve our capital. We want to make sure that we preserve our capital. If you lose a certain amount, you will have to make that much more to get back to just to break even. So we want to make sure we do that. So you can use the ATR. There's numerous indicators that you can use: ATR stop, Chandler exit, super trend, many others that you can basically support a resistance, the lower low. You can use many ways to set a stop loss. Reward is unpredictable, meaning if you're trend trading, then you won't know exactly how far the trend will actually go. But if you have set rules in your strategy where you're going to basically take profit, then that's a bit of a misnomer, because you know how much reward that you're basically going to get. The problem is why that statement is actually right is you don't know if your educated guess is going to come true. All right, because that's all we can really make in this market is an educated guess. Okay, so with that, we will move on to the last rule of trading, which is no excuses ever.
10. No excuses, ever. One time our boss invited us into his office to discuss a trading program that he wanted to set up. I have one rule only, he noted. Looking us straight in the eye, he said, no excuses. Instantly we understood what he meant. Our boss wasn't concerned about traders booking losses. Losses are a given part of trading, and anyone who engages in this enterprise understands and accepts that fact. What our boss wanted to avoid were the mistakes made by traders who deviated from their trading plan. It was perfectly acceptable to sustain a drawdown of 10% if it was the result of 5 consecutive losing trades that were stopped out at 2% loss each. However, it was inexcusable to lose 10% on one trade because the trader refused to cut his losses, or worse yet, added to a position beyond his risk limits. Our boss knew that the first scenario was just a regular part of business, while the second one would ultimately bring about the blow-up of the entire account. In the quintessential 80s movie, The Big Chill, Jeff Goldblum's character tells Kevin Klein's that rationalization is the most powerful thing on earth. Surprised, Klein looks up at Goldblum, and the latter explains, as human beings we can go for a long time without food or water, but we can't go a day without a rationalization. This quote has struck a chord with us because it captures the ethos behind the no excuses rule. As traders, we must take responsibility for our mistakes. In a business where you either adapt or die, the refusal to acknowledge and correct your shortcomings will ultimately lead to disaster. Markets can and will do anything. Witness the blow-up of long-term capital management, LECM, at one time one of the most prestigious hedge funds in the world, whose partners included several Nobel Prize winners. In 1998, LECM went bankrupt, nearly bringing the global financial markets to their knees when a series of complicated interest rate plays generated billions of dollars worth of losses in a matter of days. Instead of accepting the fact that they were wrong, LECM traders continued to double up on their positions, believing that the markets would eventually turn their way. It took the Federal Reserve Bank of New York and a series of top-tier investment banks to step in and stem the tide of losses until the portfolio positions could be unwound without further damage. In post-debacle interviews, most LECM traders refused to acknowledge their mistakes, stating that the LECM blow-up was the result of extremely unusual circumstances unlikely to ever happen again. LECM traders never learned the no excuses rule, and it cost them their capital. The no excuses rule is most applicable to those times when the trader does not understand the price action of the markets. If, for example, you are short a currency because you anticipate negative fundamental news, and that news indeed occurs, but the currency rallies instead, you must get out right away. If you do not understand what is going on in the market, it is always better to step aside and not trade. That way you will not have to come up with excuses for why you blew up your account. No excuses. Ever. That's the rule professional traders live by.
Number 10, no excuses ever. What we have here is just an iteration of don't move your stop loss, don't try to rationalize any type of deviation from your trading plan. Do not do that. Continue with your trading plan. If you don't have one, you need to make one. You need to basically put in it the strategy that you're using, your stop loss, what you're going to use for your stop loss, what you're basically going to use for your take profit, what time you're going to trade, what session, all the things of the like. You know, what type of mindset, what are you going to do outside of the hours, your chart analysis, all of that stuff. All right. But this is basically trying to make sure that you do not blow up your account. That moving your stop loss will definitely, trading without a stop loss, those things will definitely blow up your account. Taking a position size that is too large because you basically believe that the market is going to go in your direction with 100%. Don't do these things. Okay? You, in this Forex profession, most likely you won't be trading for a prop firm or a boss or anything just like that. If you've ever had a job, your boss does not want any excuses. You are your own boss right now in this market, in this Forex market. So don't give yourself any excuses. Basically, continue to trade unemotionally and use everything to your advantage so that you can stay in this game of Forex. Stay solvent. Solvent is the word. Stay solvent. Stay with enough money to basically make hopefully hundreds and hundreds of trades. Okay? So don't make any excuses. Stick to your plan. Do not blow up your account. Do not take position sizes that are too big because you want to hit a home run. Continue with the base hits and everything will come out fine. Only thing that you really have to do is you're just going to have to work on your strategy and your discipline, and your strategy, your discipline, and your money management, and everything should come out. You should be very, very, very well positioned to be successful in the Forex market. Okay, so with that, I will end this, but I believe I'm going to continue with this ebook because there are strategies at the end. So I am going to look to work on these strategies to basically give you some, you can pick one of these strategies if you would like. 5-minute Momo trade, do the right thing, the CCI trade, moving average, MACD combo, the RSI roller coaster, pure fade, the memory of price, 7-day extension fade, and turn to trend. So all of these are kind of beginning strategies that we can work on together to see exactly what's going on. And I'll probably also be doing some stuff on Forex Factory. But let's work on these for right now. And with that, I will say, knowledge is power. Be power hungry and power to the people. This is Parsival, signing out.